Welcome to the Score podcast.
If you can believe it, nearly all mortgage loans continue to use decades-old credit scoring models, while in other loan categories, much newer, more predictive and inclusive models are most commonly used. But as the Bob Dylan song goes, the times, they are a-changin'. I'm Jeff Richardson, host of the Score podcast. Indeed, next year, all conforming mortgage loans that are backed by Fannie Mae and Freddie Mac, will require credit scores derived by the VantageScore 4.0 model. To help market participants get ready for the change, a massive historical set was released that represents a portion of the GSE's loan portfolios from 2013 to 2023. The loan level data for VantageScore 4.0 includes 25 million records for Fannie Mae and 20 million records for Freddie Mac. Within both data sets, each loan has a VantageScore 4.0 credit score. Additionally, the mortgage-backed securities, RMBS as it's called, and credit risk transfer, CRT, that is, information, amounts to another 38 million records for Fannie Mae and another 33 million records for Freddie Mac. That's a big database. So it didn't take long for industry analysts to sink their teeth into the data, and I'm pleased to be joined by one of them. We're joined today by Pratik Gupta, Managing Director and Head of CLO and RMBS Strategy at Bank of America Securities. Gupta and his team are responsible for covering trends in the mortgage credit, housing, and its securitized market in the U.S., and publishing their views on relative value across subsectors and focal risk points for investors, as well as highlighting issues around governing documents and ongoing court cases. Pratik has been ranked number one in the Institutional Investor Survey for the past 4 years in the non-agency RMBS market since 2022. He has been ranked number one in CLOs for the past 3 years since 2021. His team was ranked as the best U.S. CLO research in 2021, 22, and 23 in the Credit Flux Survey, and he's been awarded with the Best Research Award by the LSTA and Deal Catalyst in 2023 and 2024. There's a trend here. He was co-head of RMBS CLO research at Nomura until 2019. He has an MBA from the Indian Institute of Management and a bachelor's and master's in electronics from the Indian Institute of Technology. Pratik, welcome to the Score podcast.
Thank you, Jeff. That was a very kind introduction. I appreciate you saying that.
Oh, you deserve every bit of it. It's impressive. So a couple of questions for you. You guys just published some research on the data set that was released. So let's start with this question. We've got this historical data set where VantageScore 4.0 scores were appended. Your team examined the data. Can you first explain why the data set was of interest to your team?
I think you hit the nail on its head when you said the times are changing. And that is true for credit scoring models, and it's true for researchers. As you get more data, we are supposed to examine it and analyze the growth. So the GSEs made this data available, to your point, after the FHFA mandated the use of alternative credit scoring models for lenders who sell loans to the GSEs. And this was really driven by two things. One is a need to expand lending to traditionally underserved segments of the market. And the other is to improve model performance metric as you get more data incorporated in these new scoring models. So the GSEs making the data available on a historical basis for loans, it allowed us to evaluate the impact VantageScore 4.0 had on credit and prepayment performance for these mortgages. And I think more importantly, the use of printed data, which I think VantageScore does, in addition to alternative sources of payments. And we can talk about rents, utilities. And that in itself, I think, is an interesting study to compare and contrast performance versus the older traditional credit scoring models. So we believe that as other sources of consumer lending utilize this process, I think it would be very critical for us to update and evaluate our own models to capture this new data. It serves two purposes for us as researchers. And this goes for me as well as my colleague Gina Curo and our team, which analyzes agency MBS. It first improves pricing in terms of the credit risk assessment, or you could talk about prepayment risk assessment for borrowers. And these borrowers may see lower traditional credit scores, but higher Vantage scores. So that in itself is a benefit. And the second benefit is that it does serve the broader purpose of expanding the borrower base, which should arguably result in broader growth of the lending market across various consumer segments.
Thanks for that explanation, and that's the why. So let's talk a little bit about the what. What specific questions did you seek to answer, and what did you find out? What were the results?
There are two questions which we try to answer here, right? One is, what is the impact of the Vantage score distribution itself versus the traditional credit scores which we already have today? And the second is whether the new credit scoring model, that is VantageScore 4.0, had a better predictive power on projecting prepays or credit delinquency trends for the mortgage set which we got access to. So I'm going to answer the credit score distribution first. First is that the borrowers who had a traditional credit score, VantageScore 4, I'm going to call it VS4, overall give a higher score on average. And we think that the quantification is close to 15 points on average. Specifically, the traditional credit score for the mortgages which we analyzed focused on the 760 to the 800 bucket, with only 14% of those borrowers having a FICO score greater than 800. What we found was that VS4 had at least 33% of the borrowers with a score above than 800, and the 800 to 840 bucket actually saw the largest share of all these cohorts. So that in itself was very interesting. The second thing is that the credit distribution in VS4 is relatively wide. For a loan with a traditional score of 680 to 720, the VS4 prime merge, as we call it, that score could vary easily from 600 to 840. So that tells us that it's a bit more sensitive to the credit scoring models in general. So more than 2,000 loans which had a traditional score between 720 to 760 actually had a VS4 score of below 600. So as a lender, I'm going to be interested in that cohort where arguably giving a much higher credit score in the traditional scoring method, but from a Vantage score point, that borrower could be more risky. Those are some of the key questions which we wanted to answer. And the second thing is this score a better indicator for prepays, such as cash out refi, and more importantly, for credit? If we are talking about credit scoring models here, we think that the different credit scores don't really lead to significant changes in the aggregate prepayment trends. And in the agency mortgage land, we call them as S-curves, where we look at the difference in prepays across various mortgage rate incentives. And we don't really see that difference at all across any credit score bucket. So from that perspective, I think it's a positive because it tells you that no matter what credit scoring model you use, agency mortgage investors should not really see differences in the prepayment buckets. And that's important, actually. Now, what we do see important is that the cash out refi activity, and that is important because a lot of borrowers tend to use cash out refis as an alternative way to raise cash from their homes. You can do HELOCs, you can do second liens, but cash out refis has traditionally been a pretty useful way to extract equity. You do see that the VS4 prime merge is a better indicator for capturing faster prepays for borrowers. If you look at an agency mortgage investor's perspective, incorporating this trend is important because that does give you a lot of upside, especially in a discounted environment, which we have today. Now, let us understand the most important part, which is the credit analysis, the delinquency trend. And this is where we do see a difference. According to us, the VS4 prime merge method had a steeper delinquency curve across each vintage and across each FICO cohort. So, for example, if you control for the same FICO bucket in the traditional scoring method, we felt that the VS4 methodology actually gave you a better indicator of the credit performance than the traditional scores. And that is important because if you can measure credit risk in a better and a more accurate manner, that makes our job a lot more easier in trying to understand how losses would evolve, especially when you have a recession or a slowdown in the economy. That I think is a very good thing for the market to have.
So that was really interesting insights and quite promising as we march towards the implementation of VantageScore for mortgage origination. But your focus tends to be on the RMBS market, the securitization side of it. So based on these findings, how will the RMBS market benefit from using newer scores like VantageScore 4.0?
I think the benefit would be in two areas, at least two areas. So one is just credit performance. And as I highlighted that if we think that the VS4 had a better predictive power for tracking credit delinquency trends, this would actually help in affordability metrics across the board. So first of all, because VS4 has a higher average credit score versus the traditional scoring models, if I'm a mortgage lender and I see that borrower to be a lower risk borrower versus what I used to have in my older methodology, that should arguably help in lowering the mortgage rate. And the reason is, if you recall, a lot of the GSE lenders, they use this matrix called the LLPA matrix. It's called the loan level pricing adjustment matrix. And that matrix basically gives you a higher mortgage rate as your credit score basically declines. So if my credit score is improving because of the VS4 methodology and the VS4 is a better predictor of credit performance, I think that in itself should lower mortgage rates. That actually helps the affordability matrix. It also helps me as a CRT investor, as a credit risk transfer investor, when I look at the FICO scores or I look at the VS4 scores, and I'm trying to model what future losses or future credit delinquencies could look like, if I have a better model or better mousetrap in front of me to project delinquency trends, I can price my risk better in the CRT market. And that benefit would actually pass on to the GSEs too, who will see a lower cost to share risk with private investors versus what is the case today. So I think these are the two benefits which I see from a credit performance perspective. And I think the second more important one is just broadening the customer base. And I think if I saw your presentation and I saw the materials you have, if the VS4 scoring system actually captures additional borrowers, that should actually help in expanding the lending base, not just for mortgages, but for a range of consumer credit products. And if you see in the mortgage market, a lot of traditional underserved segments are locked out of the housing market because they lack access to the traditional credit scores, or they're either more punitive. And if you see in an analysis that 50% of the borrowers with a traditional credit score of 680 to 720, 50% of those borrowers actually had a VS4 score which was higher than 720. So that basically tells you that that particular borrower, A, could either qualify for a GSE mortgage in the first place, and B, if they do qualify, they will actually get a lower rate, all else equal, assuming that the GSEs do incorporate this new model. So those are the two benefits which we see: broadening the customer base, improved credit performance. And finally, the improved cash out refi predictive performance should also give servicers and originators an additional edge in marketing such products to borrowers. That's also another benefit which we see on the margin, but I think the really two important metrics are the credit side as well as broadening the customer base.
Such an important message for the market to hear: more predictive, more inclusive, and even providing some lift to predict cash out refis. Pratik, thank you for your insights today, and thank you for being among maybe the first to dig into the data set and doing this critical research so that we can move forward with this important change.
It was our pleasure, Jeff. I really appreciate you having me on this podcast.
Having been at VantageScore virtually since the company launched in 2007, my colleagues and I have been saying this until we're blue in the face. VantageScore offers predictive performance lift and the ability to expand credit to underserved borrowers. It's incredibly gratifying to hear others share their data-driven insights and come to similar conclusions. I'm Jeff Richardson, and I look forward to our next discussion.
The views and opinions expressed in this episode do not necessarily reflect the official policy or position of VantageScore Solutions. Visit VantageScore.com to learn more.